Good morning, everyone. It's 10 a.m. on Tuesday, August 18th, 2020, and this is 10 on Tuesdays. I don't have a guest joining me today, but I'm really excited about this episode. I've been thinking about this for a couple weeks of what I was going to talk about, and I had decided to do tax top 10. And what is the top 10 in sales tax? Well, I came up with a list of things that I really think you need to know about Wisconsin sales tax, but keeping it high level. So I'm excited to share that with you. I'm Holly Hoffman, founding partner and CEO of the Sales and Income Tax Advisory Network. Prior to creating my company, I worked for the Wisconsin Department of Revenue as an auditor, speaker, and sales tax specialist. My passion is to help provide sales tax education and support to tax professionals, businesses, and associations with the goal of building a network of empowered taxpayers. For more information, visit my website, salesandincometax.com. So thank you for joining my web chats 10 on Tuesdays, every Tuesday from 10 to 10:30 a.m. You can check out previous episodes on my 10 on Tuesdays channel. To find my channel, go to salesandincometax.com and look for the 10 on Tuesdays logo. You can click on the logo to register for the weekly webinars or click on watch previous episodes to access the 10 on Tuesdays channel. So let's not hesitate anymore. Let's get into our top 10 of sales tax. And I'm counting them down from 10 to 1. Number 10, Wisconsin adopted a sales tax in 1961. It was implemented in 1962. Of course, over the years, the rates and complexity have increased. In 2009, a huge overhaul of the statutes and administrative code occurred when Wisconsin became a member of the streamlined sales tax. And the great thing about that is at least our definitions and a lot of procedures are similar to 22 other states, 23 almost. But just so you know, just because we're a member of Streamline doesn't mean that all the states in Streamline have the same tax treatment. So same definitions, but not necessarily the same items taxed or exempt. Number 9 and number 8 are somewhat connected. Number 9, the imposition of sales tax is interpreted very broadly, meaning what is subject to tax is more ambiguous, and courts will err on the side of including more items or services as taxable when deciding about a case about whether or not sales tax applies. The point of this is that the burden really is on the state to prove that something is taxable, but it's very broad. So it's intentionally written that way. It's intended to include more than exclude. In contrast, number 8, exemptions are the opposite of how sales tax imposition is treated. Exemptions are very specific and narrowly defined. They're intended to be so. It's intended to be very limiting of what, based on criteria, and they're not meant to be applied loosely. Burden is on the taxpayer to prove an item or a service is exempt. So 8 and 9 are important to understanding when you're looking or thinking about your sales or purchases. If it's something like services are exempt unless specified, so there's certain specified services, but like sales tax on service to tangible personal property, that's going to be interpreted very broadly. You know, they very clearly do not set up very specific criteria. But when you talk about exemptions, if you have any exemptions that apply to your purchases, you know that there's very specific criteria that you need to identify and document in order to substantiate that the exemption applied. And in audit, you need to prove that you met those criteria in order to not be subject to a sales tax assessment. So That's very important overall understanding between imposition versus exemptions. Number 7, Wisconsin taxes labor and certain services. The sales tax has generally been thought to be inherently regressive. So let's just talk about that a little bit. Because the proportion of an individual or family's income devoted to consumption declines as income increases. So people at lower income levels tend to pay a larger share of their income tax in sales tax. They are making more purchases, and the sales tax takes up a larger portion of their income. The sales tax base and exemptions, however, have a significant impact on the degree of sales tax regressivity. One of the broadest exemptions in many states applies to personal and business services. So most states exclude taxing services. Unlike most consumer expenditures, spending on services tend to increase as income rises. So the more money you make, the more likely you're purchasing services. If you have less money, you're likely to purchase items and do the work yourself. Therefore, imposing the sales tax on most services could reduce the regressivity of the tax. So Wisconsin taxes certain specified services, like services to tangible personal property, admissions, landscaping, cable TV, amusement devices, producing, fabricating, and printing, parking, photographic services or videographic services, lodging for less than a month, contracts for future performance of services, telecommunications and ancillary services, towing, delivery charges, and laundry dry cleaning. So for a full description and some examples, check out Wisconsin Department of Revenue Publication 201 for more information on those specified taxable services. But as part of this, I say Wisconsin taxes labor because labor is generally included in a service. So if a contractor is providing service to tangible personal property, their labor is going to be taxed. The difference is the states surrounding us, Minnesota and Illinois, for example, they don't tax labor. They don't tax service labor. So that is a difference when you're working between states, and it's something you need to keep an eye on, but don't get confused on that. So we definitely tax certain services. Number 6, understanding the occasional sale exemption. So in Wisconsin, we have an occasional sale exemption, and those sales are exempt. If the seller qualifies for the occasional sale exemption, the purchase is also exempt. So if you're a business and you purchase a lawnmower from the gentleman down the street, he doesn't own a business. He's not in the business of selling lawnmowers. He just personally had a lawnmower and sold it to you one day. So they qualified for the occasional sale exemption. That also means your purchase is exempt under the same exemption. What you need to do is substantiate your purchase as being exempt as an occasional sale. So you identify who the purchaser was, when the purchase occurred, the purchase price, all the information, so that you can show, if you're under audit, you can substantiate that it was an occasional sale. People or businesses who make occasional sales may not be required to hold a seller's permit and collect sales tax. Generally, Wisconsin considers anything less than $2,000 in taxable sales in a calendar year as not someone in the business of making taxable sales. So you would not be required to hold a seller's permit. If you make taxable sales exceeding $2,000 in a year, if they are rare and sporadic, meaning they're not regular, and regular doesn't mean they happen every day or every week. Regular can mean once a quarter or once a year you have an event, something like that, a taxable event, that's regular. It's going to happen. But rare or sporadic taxable sales that may exceed $2,000 in a calendar year you may also still qualify for the occasional sale. There's different standards for nonprofits, so just be aware of that. But the same thing holds true. Occasional sale is occasional sale is an occasional purchase. But there really is no occasional purchase. It's just how I like to think about it. Again, occasional sale is exempt. A purchaser of goods from the occasional seller is not required to remit use tax. However, they must document it, and we talked about that. Just a note, occasional sales do not apply to inventory or to motor vehicles. So motor vehicles is a huge thing that people might sell occasionally that is taxable. So if, same scenario, instead of buying a lawnmower from the gentleman down the street, you purchased his van, even though that person isn't required to hold a seller's permit because they're not in the business of selling vehicles, they don't hold a seller's permit, they're not making sales more than $2,000 in taxable sales or regular taxable sales throughout the years, it's a motor vehicle. So they're not required to charge you tax. They don't hold a seller's permit. When you go to register that van, you need to remit use tax to the DMV at that time. So just keep that in mind. It does not apply to motor vehicles. There is also an occasional sale if a business ceases to operate, shuts down. The sales from the liquidation of that business are not taxable. Again, it doesn't apply to inventory or motor vehicles. It also can apply, a business may not completely shut down, but they close one entire location. If that entire location is closed, the sales of equipment and supplies from that location are not subject to sales tax. That would be an occasional sale. Again, there's not any specific certificate or anything like that that can be provided to the purchaser to document. You just document with who the seller was and the circumstances of your purchase to ensure that you don't have to pay use tax. Number 5, tax decisions are made at the time of purchase sale. I really wanted to talk about that. Sales tax isn't like income tax. Income tax, you sit down once a year. I'm not saying you don't make decisions throughout the year, but generally income tax, you sit down once a year. You talk through what your plan is and your strategy for the year, maybe for the past year prior to filing, and you come up with your tax planning decisions. Sales and use tax are different, and that's why I'm so much about education and training, because sales tax decisions and planning occur at every step of the transaction, whether it's the time of purchase, the time of use, the time of sale, even as much as at the time that an estimate is provided before the sale. So I want to make people aware that each step of the way you need to think about, do you need documentation? Is there a better way to structure your purchase? If you have multiple entities, or maybe you need to create multiple entities to reduce the impact of sales and use tax. There's a lot of different ways that you can do things. There's different exemptions out there to take advantage of them and use them. And it's really tax planning, but there's so many different levels of where that occurs. And then you want your folks who are the estimators, who are the purchasers, if they hold purchasing cards or are out there signing contracts. Your folks who are have access to inventory and are pulling inventory for different uses. All these people need to know what what information they need to report or document, or documentation they need to obtain in order for the accounting department or the owner or whoever's doing the books to properly document whether an exemption applied, if something that was purchased exempt was then used in a taxable manner. One of the big things that I see is businesses who, maybe you're in manufacturing, you purchase forklifts. You maybe have 3 forklifts. This applies to farming too. Maybe you have 3 forklifts and you decide to use them throughout your plant, not really documenting what each one is used for. When someone comes and audits you, they look at whether or not the forklift was used within the scope of manufacturing and whether or not it was used exclusively in the scope of manufacturing. Now, technically, if you used all 3 of those forklifts to load trucks from finished goods inventory or transfer items in the raw materials inventory storage prior to entering into the scope of manufacturing, or where manufacturing begins or where manufacturing ends, none of those forklifts qualify for exemption, the manufacturing exemption. However, if you were making determinations at the time of purchase, you have 3 forklifts, one you use exclusively for the taxable jobs, the storage areas, the prior to or after scope of manufacturing ends, and the other 2 used exclusively in the scope of manufacturing, moving goods through the production process, then suddenly now you have 2 forklifts that qualify for exemption for repairs and parts and purchase. So don't lose out on money because of poor planning, because you didn't document where things were used, how assets were used, things like that. So tax decisions, that's just some examples of tax decisions being made throughout the process. Number 4, I don't see people talking enough about contractor services are important tax decisions. When you're talking about tax planning and tax decisions, every individual and every business is impacted by contractor services. So whether you're in the business of providing such services or you're the consumer of these services, contractor services not only occur everywhere, for every person, but they also encompass a lot of different things, from new construction or renovation to repairs to maintenance, cleaning, and inspection services. So more than what you really think about when you hear contractor services. Usually these expenses are significant or they're regular and reoccurring. So that means they have a more impact on dollars. So it's crucial to think ahead and plan as to how sales and use tax impact these transactions, and documentation is key. From the estimate to the contract to change orders to the invoice, and then on to your depreciation and disposition schedules for these items. It's really important, depending on what the service is or how it's used, or what area of your business these items are used in. When you talk about whether or not you have multiple entities, which entity is purchasing it, how it's being used, all these things need to be considered before the services take place, because once the contract is set up and structured, that's how it appears to the auditor. And it's very hard to say, but no, it was really purchased by this company and used in this manner, or however you think it best serves you after the fact. It's impossible to change it at that point. So just be very careful. High dollar, high impact. And after the fact, this is also a place to look for preparing for audit. Like before before you get the audit notice. Like right now, today, if you were looking at places to review whether or not there's a refund or you have a liability as far as tax is concerned, I would look to your contractor services. Number 3, if you're under audit in Wisconsin, and I feel like I say this in almost every 10 on Tuesdays, but be on notice that it's solely your responsibility to review records for any possible overpayment of sales and use tax. Is it common that you would have overpayment of sales or use tax? Absolutely. Just as often as people make mistakes on underpayment or mistakenly not paying or missing that sales tax wasn't charged on an invoice, you make the same mistakes in the other direction. So absolutely it's common. If you have errors of underreporting, it's guaranteed that you made errors in paying too much tax. And just again, auditors will only look at the underpayment of tax. They're looking for an assessment. They're not looking at errors that go in your favor. So make sure you're looking for this. It's better to keep the money in your pocket up front. Don't want to lose it. You don't want to wait for an audit to find out that you were overpaying on tax. Likely you're going to have years that fell off the statute of limitations that you can't get that money back. So definitely this is part of your tax planning and business planning. Make sure you're regularly reviewing your records and your procedures to make sure you're not overpaying tax. Number 2, this is just a reminder, sales tax is collected in trust for the state. It's a reminder but a warning. It's easy to fall into the mindset that the sales tax you collect from customers is part of your revenue or income. So you invoice it, you collect it as part of the sale, it goes into the same bank account. Each period you do your return. I've seen so many times people run a report, sales tax report, and then they make adjustments for errors and then submit their return along with the tax. But keep in mind, sales tax is not like income tax. Any sales tax that you collect from customers is not your money. It's collected in trust for the state. So therefore, if your software has glitches or can't account for certain things, which is common, and that glitch causes over collection of sales tax, you can't simply adjust your reports and remit only what tax was due. If you incorrectly collect tax from your customer, you must either refund the tax to your customer or remit it to DOR. You can't adjust your reports and then just keep that money in your account. Also, if you're running short on money and you need money to make ends meet, do not use the sales tax you collected as a source of funds for other business expenses. It is technically a theft of state money. But also, once you use that money, I mean, it's good in the short term. It gets you through, it pays that bill, it gets that debt collector off your back. But it is so hard to catch up, and sales tax adds up so quickly. So I strongly advise to never even go that direction, never even consider using your sales tax funds to pay other debts. And the number one of my top 10 of sales tax is about requesting a refund of sales and use tax. I can't tell you how many businesses I've talked to who they're, oh, I know, I'm paying too much, but it's okay. And well, if my accountant said that if I ask for a refund, that's a red flag, and I don't want to do that, and maybe it's too hard, I don't know how to ask for a refund. The statute of limitations for sales and use tax is generally 4 years. This means that if you overpaid tax, either sales or use, you can correct that or ask for a refund of that tax for up to 4 years back. So if you know that you're overpaying tax, you should definitely adjust it going forward. And then you should look about whether or not you want to file for a refund. And if it's a significant amount, I definitely encourage you to correct that for the past 4 years. If you charged sales tax in error to your customers or emitted use tax in error on your returns, you can either amend your sales tax returns for the period in which the tax was remitted to get that refund back. However, for sales tax you collected in error from your customers, you are going to have to refund the tax plus interest within 90 days of receiving that refund back from DOR. If you don't refund that back to your customers, you have to return that money back to DOR. It is just like what I talked about earlier about that money is collected in trust from the state. You can't overcollect and then later go ask for a refund and then pocket the money. It's the same thing as if you would have pocketed from the start. The only exception to that is if you made an error, and I know people don't intentionally charge sales tax incorrectly because that's bad business practice and is not good for competitive standing, but if you make an error in charging sales tax and you get audited, if you're under audit, you do get to keep the sales tax charged incorrectly. So in that point, then it's a business decision. You can choose to refund to your customers. Often, it's not a situation where it's easy to identify the customers or it's such little tax. It just administratively is a burden. So under audit, you would get to keep overcollected sales tax, but day to day, if you incorrectly charge sales tax to your customers, you cannot request a refund and keep that money. You either have to return it to your customers or give the money back to DOR. You can't keep that. There is one other exception. If you were a contractor and you incorrectly classified a sale as, say, personal property instead of real property, and you want to correct that, you can ask for a refund, and your refund of the sales tax you collected from your client can be used to offset your use tax on materials. But then that remaining money needs to be refunded back to the customer. So you can pay DOR the use tax that you then owe on materials, but the remaining money would need to go back to your customers. Requesting a refund is not a red flag. I mean, mistakes happen both ways, and that's not something that you would get punished for. The only time it's a red flag or you need to be concerned is if you're doing other obvious things wrong. So if you're going to request a refund, you identify that you overpaid use tax on something, make sure that you also look at the rest of your sales and use tax procedures and system and identify any other overpayment or underpayment of tax. Because yes, if it's obvious that you should have been charging sales tax and you're not, or your percentages are off, or maybe you asked for a refund of sales tax and when DOR is processing that, they notice you never remitted use tax, and whatever your business is, use tax would definitely be a consideration or significant. Yes, then it's going to cause a red flag. So if you're going to submit a refund, just do a once-over review of your whole sales and use tax. Maybe it's a good time to make all corrections at the same time, but generally, requesting a refund is not a red flag. DOR doesn't want to take your money and hang on to it if it's not something you actually owed. So Do not think that. And I hope people get that message loud and clear. That's not how it's looked at DOR. So I hope you enjoyed my top 10 list. Sometimes we get so overwhelmed with the complexity of sales tax. It's important to remember the overarching factors to keep in mind that help your business manage sales tax. So thank you for joining me today. Next week is a very exciting week. We have attorney Tim Shalley of the Michael Best Law Firm on, and we're going to talk sales tax and totally nerd out. So I know whatever we discuss is going to be very important and useful to everyone. So be sure to tune in next week, Tuesday, for Tim Shalley of Michael Best Law Firm. To rewatch this episode or to view previous episodes of 10 on Tuesdays, go to salesandincometx.com and check out my 10 on Tuesdays channel. And I will see all of you next week. Have a good week and a good weekend. Thank you.